Welcome to Asset TV here at the Morningstar Conference in Chicago. I am joined by Troy Johnson, Director of Fixed Income Research at Denver Investments and a co-portfolio manager for Westcore's Fixed Income Group. Thank you so much for joining us, Troy.
Yeah, thanks for having me.
Of course. So why don't we start with an overview of your approach to fixed income investing?
Right. So our philosophy and approach to fixed income investing is driven by the fact that income drives returns within the bond market over long periods of time. With that in mind, we understand that we don't need to trade in and out of the bond market or trade in and out of specific securities, but rather target areas within the bond market where we can get that additional income and hopefully turn that into total return for our clients. Of course, key to that is being very rigorous in our security selection process and moving forward with that, monitoring the risk of the portfolios from a portfolio management point of view.
And your funds recently were recognized at the Lipper Awards, which took place in New York a few weeks ago. Congratulations.
Yeah, thank you.
Tell us a bit more about that.
Yeah, we're real excited about that. What the Lipper Awards signals is that the Westcore Fixed Income Group was labeled as the top performing small fixed income mutual fund group for the track record of 3 years worth of performance ending November of 2016. We think that really talks to our process and philosophy and really validates the team process that we have in place and the hard work that our team has put forth for our clients.
Fixed income is changing, the landscape is changing. We've been in a low interest rate environment for a while, and now we're seeing some consistent rate hikes from the Fed, albeit in small increments. Right. What are some of the opportunities you're seeing now?
Yeah, the opportunity set for us doesn't change much. Remember, we're more focused on investing versus trading. And so with that long-term orientation, we really see opportunities in the corporate bond market. Within corporate bonds, what you get is you get that additional yield pickup versus what you can find in the treasury market per se. And with the outlook for the economy, where we stand today, it makes a lot of sense to continue to have that overweight in corporate bonds. Another thing in regards to the potential for rate increases, as rates do rise, there is an offset by being invested in corporate bonds. Not only do you have that yield pickup that takes a little bit of the, buffers a little bit of that movement in rates, but in addition to that, there's the opportunity for spread tightening, which can cause the corporate bond market to outperform during a rising rate environment as well. When people look at the historical results within the corporate bond market, what they will see is there's probably less correlation to the U.S. Treasury market than they may have perhaps thought there would be.
So corporate bonds, one to look at. Another thing that I'm hearing a lot about, high quality junk bonds. It sounds like an oxymoron, but is it an opportunity?
We feel it's an opportunity. When you look at high quality junk bonds, or what we characterize as typically associated with double B oriented high yield bonds, what you find is that they sit in a differentiated spot on a risk return profile versus the other areas of the high yield market and even areas of the investment grade corporate bond market. And what that means is that an investor that's looking for that additional yield within the high income environment or in the high yield marketplace, but maybe doesn't want to take on the volatility of the overall broad high yield market and investing in single Bs and triple Cs, can still get a nice return by focusing on the double B segment. In addition to that, you're not undertaking that volatility, and an investor that's more worried about volatility really wants to make sure there's capital preservation within their investments, should look to the double B segment of that market for a nice total return opportunity. In our view, when we invest in high yield, that's where we're looking. Because we feel that when you move down into the single B and triple C areas of the market, you're exposed to more default risk and you have to trade in and out of those securities, and we're investors, not traders.
And what makes the fundamental research process at your firm different?
Yeah, we have a very differentiated approach to fundamental research. Obviously, by focusing on the areas of the market that have that additional income, we have to be very rigorous in our approach. The differentiating factors for us is the fact that our analysts cover securities in the corporate bond market rated triple C all the way up through triple A. That's a different approach. You won't find that in most of our peer group. In addition to that, it's an analyst push process. If you go to other firms, it's the portfolio manager dictating to the analysts what areas they want them to look at, what yield target they need, and to bring me your best idea. At our firm, we ask the analysts to look all over their universe and bring us their best ideas without having that portfolio manager pulling those ideas out of those analysts. We think that's the best way to approach the market. Secondarily, getting back to our long-term orientation, our analysts aren't looking to trade in and out of bonds. And so because of that, their research is focused on really understanding the competitive positioning of these issuers, understanding the underlying asset value, modeling out cash flows, and focusing a lot on the potential downside or the risk associated with an investment. So as our analysts look at companies, they really try to understand what could happen to the competitive positioning of that issuer, and over time, what could that mean to the financials? So we not only model out the base case scenario, but also model out the downside. That long-term perspective is key. Another area that differentiates us is the analysts bring these ideas to a group discussion. It's not just an analyst and a portfolio manager talking about the appropriateness of an investment. It's an analyst discussing in a group setting with all of the other analysts that cover various industries and all of the portfolio managers discussing the merits of investing in a specific security. We think that draws in the collective resources of our group, utilizes all the experience set and skill set that we have within our group, and it really causes us to be a very, I would say, more uniform process so we can develop that consistency and stay true to our discipline of really understanding these credits and their appropriateness for the portfolio. And then lastly, in regards to differentiation, I would say the most important part of that is that we go through all this rigor in our credit research process, but us being a smaller size firm, what we're able to do is utilize that research to gain access to securities on the secondary market and be able to actually put securities into the portfolios in an amount that impacts the performance of the portfolios. If you're at a bigger shop, you're not able to do that. You have to focus more on the primary new issuance market or even use credit derivatives in order to boost your portfolio's performance. So we really want to leverage our analysts' research, and we're able to impact the portfolios by buying those bonds in the secondary market in a size that benefits us, and we think our size is an advantage in that regard.
Well, Troy, thanks for taking the time to share some of the opportunities you see and the process you use to find them.
Thank you.
Of course, and thank you for tuning in. From Asset TV's Morningstar coverage, I'm Jillian Kemmerer.